G'day, and welcome to the Pumped on Property Show podcast. How you doing?
Really good today. Feels like we finally got a little bit of clarity and some really cool stuff to talk about today.
I'm literally excited. Like, this is a full-blown geeking out data podcast.
Yeah.
For those of you who want to get a really, really clear idea of what CoreLogic, the Reserve Bank of Australia, SQM Research, CBA, Phil Anderson and Fred Harrison are saying, then this hopefully is going to make you sleep a hell of a lot better tonight. For the first time in a while, some positive news has been coming out and we're excited to show that with you. Like we've been saying for months now, we will get through this time, but the early stages of the data suggesting that we're going to get through this are starting to come out now from the big dogs. Let's talk before we get into this, man, about the crazy weekend that you and I just had.
Oh my God, so fun. Hey, it's Wednesday now. That we're recording this one, and on Saturday/Sunday we did a kayak trip, an overnight camping kayak trip, which was just wild. I was so fatigued for a few days. I'm only just starting to get back to normal. Like, even this morning I woke up and I'm like, man, have you still not caught up on sleep?
I did like a training session yesterday with Lisa and then one yesterday Arvo with the kids, and I'm like, I'm not even going anywhere near shoulders because they're still so sore from it.
Oh man. So what we did, we went out to West Queensland, not too far from where we are.
Like the sunny coast hinterland out at Kenilworth?
Yeah, and we paddled down the Mary River. I think we probably did 15 to 20 Ks or something like that.
Definitely felt like it, hey?
Oh yeah, it was wild, but we didn't really have enough food out there. We didn't have enough water out there. We got ourselves into something we weren't really prepared for.
I didn't take a sleeping bag, and I took this tiny little mattress because I'm like, I'll be sweet, I'll just sleep under the stars. And then like literally hardly slept all night as well.
I'd never felt so grateful to see the end of the road where we parked the car. Like, I was getting to a point in my own mind, I was just like battling these demons going, I was so sore, I was so tired, I was so hungry. And I'm just like, come on, Mary River, please show me some good news. Please show me a light at the end of the tunnel. And about 10 minutes later, I paddle around this corner and I was leading the charge and saw this thing, and I just yelled out a big hoot. And then I'm like, oh, I got to be quiet because I want the boys to experience what I just experienced.
It was sick. Like, parts of the river were like 100 meters wide and parts of it were like literally a meter wide. You know, there were little rapids. There were like parts where you had to drag the kayak over rocks and sticks and logs. We made this huge fire on this riverbank and just like watched the stars and talked about everything from like our pasts and girls through to consciousness and the universe.
It was beautiful.
Business. It was just a perfect night out there, eh?
Yeah, well, what I was saying, I live in a place where it's quite light polluted. There's lots going on around and you don't get to see the stars the way that we did. Like, you could completely see everything, the Milky Way, the clouds in the sky. What do you call the clouds?
I think the Milky Way is our galaxy that we're in, man. Every time you see a star, that's the star in the Milky Way.
Oh, there you go. I'm not an astrologist.
But I saw 2 shooting stars, which was sick, and it was just fun, like, you know, chopping up wood, getting the dead branches, building a massive fire, like cooking. We just had literally like snags with a skewer thing, and we just like cooking these snags on the barbie and probably end up eating like 5 or 6 snags each on sangers. It was just sick.
Just living the dream.
The sort of stuff you do when you're younger and then you have kids or you get a job or you start the business like Simon and I have, and it's like, you forget to do crazy shit that tests you, but it really was like that for me.
Yeah, definitely. And just to connect back with nature, like, we're both surfers, so we spend a lot of time in the ocean, which we're blessed for, but I've never been someone, like, our dad's always been a surfer as well, so all of our holidays growing up were to the beach, and which
I loved.
Which was awesome, but to go out west and get into the hills, get into the mountains, into the rivers, and connect with that side of nature as well was really, really nice.
Now, I just read an email this morning, which I'm not going to talk about today, but I'll definitely do another podcast on it. It's Phil Anderson's step-by-step plan for exactly how he trades the cycle, what he does with property, what he does with businesses, what he does with shares. when he's fully leveraged in the market and when he's out of the market. It was absolutely mind-blowing. So keep an eye out for that one coming soon. What I've realized through this period is there's really, really good sources of data. I've been following a couple of the sources now for about the last 2 years, particularly SQM Research and the research side of the Commonwealth Bank, and they are just spot on. I can't even believe how accurate their forecasts have been. CoreLogic's also been cool. The Reserve Bank puts information out there. So let's sort of get into this data. In terms of Phil Anderson first, we'll just give a really quick update there. We've just sort of summarised some of his emails we've been receiving in the last month. The first is that there's absolutely massive global bailouts going on right now.
Huge, and they've actually got the numbers for this now. So it's looking like in terms of GDP that those countries are putting in to bail out these countries from the coronavirus is just massive, unprecedented. So in the US, they've put forward 11% of their GDP, which is about $4 trillion US dollars. Japan's put in 20% to get through this, Australia 10%, and Canada about 8.5%. So this is just massive, massive, massive dollars, which we'll get into with the CBA stuff and what they said about these bailouts in Australia, but just big money.
Big money. And what that means, for those of you who haven't read Ray Dalio stuff, Phil Anderson stuff, Warren Buffett stuff, or Fred Harrison stuff, every time we get these really low interest rate environments, or every time we get quantitative easing, which is printing money, or every time we get these, big government bailouts that we've talked about here, what happens is all of that money trickles back into society. Generally, first it comes through through spending. Some of it goes back into the government, but a lot of it goes into savings, and then from there effectively put back into the economy in terms of assets, which are stocks and property prices. So a lot of this money now is going to find its way into the real estate market in the second half of the cycle, and that's the way that it's always been. Unfortunately, the land always grabs the long-term value. So think about any place in Australia like a mining town where wages spike really quickly. All of those wages end up in ridiculous land prices, ridiculous rents. And then as soon as that environment or market gets to a point where it's overcooked or people can't afford it anymore, or the mine leaves town or shuts down, the land prices go back to their true value. So you can look at the overarching real estate cycle as the same as a mining town. There's a period where there's nothing going on, then it goes absolutely crazy, and then after the craziness, it comes back down. And I think there's a really good way to look at the overarching market. In a mining town, that might happen in 2 years, where in the overarching cycle, it generally takes between 14 and 20 years to occur. Phil just also reminded me that this has happened before. We've talked about this previously. We had the 2001 mid-cycle slowdown, which was driven by September 11 and the dot-com boom and bust. We had the 1981 one, which was driven effectively by interest rates for our parents going up to 15 to 18% globally. We had the 1961 mid-cycle slowdown where we got the Cuban Missile Crisis. So it's important to remember the past and to remember that we have gone through these environments and we have also got through them before as well.
Yeah, and in the first couple of months, sort of March, April, you could see a lot of these people trying to pull together all of this information and figure out what's going to happen. And at the start, it felt like there was a lot of uncertainty and nobody knew what was going on. But now we've had a couple of months of data being produced and people are actually able to put the pieces of the puzzle together. It seems as though we've got a bit more clarity on everything that's occurring right now and how long this is going to last, how bad it could potentially get.
Everyone remembers 6 to 8 weeks ago when people were running into the supermarkets, bashing each other for toilet paper. The same thing happened in the year 2000, which was the Y2K bug, where people started to hoard, build shelters and basically fight each other. The same thing was happening in the 1960s when there was the Cuban Missile Crisis. So it's not the first time that people have been fucking idiots in history and it won't be the last time either. So just remember that, we get a choice to live through these environments. If this is the first time you've heard about this stuff or living through it, then observe it And next time when it comes around, manage your emotions better, manage your fear better so that you can take advantage of stocks when they're on sale or properties when they're on sale.
Exactly. Going into, I think, probably the SQM stuff, I just love all of these people that we're talking about are so unbiased, and it's all just based 100% on data. So SQM have come out with probably, how many emails do you reckon you've received from them over the last 3 weeks?
Probably 3 really solid emails, and then I've been looking at their blogs, and there's a lot of good quality content on their website for anyone that wants to check it out.
Now, Ben was talking about what the shape of this recession is going to look like in another podcast, and we were talking about a few different potential options, which was a V-shaped recovery, which is a sharp decline and a sharp recovery. There is a U-shaped recession, which is sharp decline, bottoms out for a while, and then rises back up quite fast. And then the third one, what's the third one?
Just a really bad market for a long time, like a Great Depression where things don't get better for years and years and years, and it really takes a long time after that to recover as well.
Yeah, so initially SQM believed that it was going to look a bit more like a U-shaped recovery, but now a few weeks later that they've got a bit more information together, they believe that it's going to look more like a V-shaped recovery, which essentially is the best case scenario.
Yeah, really, really painful environment, getting caught at the bottom for maybe a year or so, and then a sharp recovery. And that's a hell of a lot better than getting caught at the bottom for 3 years. So some of the information that we're going to talk about now, I'm just going to read some off the laptop and some off the whiteboard behind you guys, is what's happening right now is we've got higher, or expected to have higher than usual vacancy rates.
Yeah, which makes sense. And this is what we've been told from our property managers already.
There's a number of reasons. One, people don't feel confident moving right now.
Yeah.
People are losing their jobs and their businesses at the moment, and that's taxing people. Some people can't afford to pay their rents as well. Then you've got 200,000 properties that were on Airbnb that have just come back onto the market. I put one of them back onto the market, the long-term market myself. You've got all of the people that were due to move here this year, the 300,000 or 400,000 new Australians from overseas that would have come in. And then we've got about 200,000 students that haven't showed up this year, as well as all of the tourists as well. So there's a reason why vacancy rates are going to spike. And it's not so much because there's a massive amount of extra supply. It's just that Australia's been living this dream based on tourists, students, and immigration that this year has been ripped out from underneath us. Auction clearance rates are also much lower. The fact that you can't legally have an auction the way that you could is part of that. The fact that people are freaking out and not putting their properties on the market is another one. The days on market, which is an indication of demand, has now started to last longer. So, sometimes properties could sell in like 5 days or 30 days. Now we're seeing properties staying on market in certain environments for longer, which means that it becomes more of a buyer's market, which you're already seeing.
Exactly. So what was happening here as well, because this has all only occurred over a 2-month period, and the conversations with the real estate agents and the vendors would have started potentially late last year, the start of this year. So their expectations, the vendor expectations, were set prior to the coronavirus, and now that everything's occurred, those vendors are still trying to search for that price that they were promised from these real estate agents. So that could be another one of the reasons it's increasing these days on market as well.
Yeah, a lot of people thought there was going to be a lot of blood on the streets with property. We'll talk about that more in a moment in terms of what Commonwealth Bank's saying in relation to the blood on the streets right now. But certainly from SQM's perspective, it hasn't been anywhere near as bad as they were expecting. The average vendor discount is a really, really good indicator to look at. And I've been saying this to clients for weeks. Based on the current market conditions, I believe from the top of December last year, prices in Sydney, Melbourne and Brisbane have probably come back 5%. Now, in Sydney and Melbourne, that would be a true 5% or 10%. In Brisbane, it's mainly the off-market properties that we're seeing that. Yeah. It's not so much the market is shifting too much in Brizzy. It's more there's access to some distressed properties for the right people that represent really good value.
And what's happening there is we're getting a lot of off-market listings as buyers agents right now. I think in the meeting on Monday, Crystal and Adam were saying about 60 to 70% of the properties that we inspect every week off or pre-market. So what's happening is the vendors are pretty much too scared to list their properties, so they're happy to let the real estate agent test the water with some buyer's agents or their pipeline, which has been really great for us because we've been able to get lots of off-market listings recently and been able to get them at that 5, not necessarily 10% discount at this point, but probably a 5% discount.
For sure. Now I'm going to read some of the article here that we got from SQM. Effectively, they last year in October made some really interesting forecasts based on a range of different scenarios. Now, they're saying that only the 4th scenario is relevant today, which is they were expecting the trade war to be the trigger for this mid-cycle slowdown, but it's obviously been the coronavirus.
Which essentially is a trade war anyway because nobody can trade.
Yeah, exactly. Like economy weakening, RBA to cut the cash rate to basically 0% by the end of this year.
Yep.
And quantitative easing, meaning printing money to start. Now, based on that scenario, they're expecting prices in Perth to drop by between 2 and 6%, Brisbane to drop by between -3 or +1%, Darwin to drop by -7 to -3%.
God, Darwin's had a rough decade.
Yeah, Darwin's had a really, really, really tough 6 years. And that was just because of a mining boom before that. Like prices went up in Darwin by 100%. Now they've come back by 35%.
Representing.
Yeah, people that bought a decade ago are still up 65%, but people that bought in the last 6 years have been smashed.
Yeah.
Sydney, they're saying between 0 to +4%. Melbourne, the same. Adelaide, -2 to +2%. Hobart, +3 to +6%. Canberra, +4 to +7. I believe that based on what I'm reading here, their worst case scenario numbers here aren't going to look relevant by the end of this year. I think it's going to actually look probably worse than this. They've said the outlook for housing in scenario 4 was one where the market would eventually stall and start to record price decreases from mid-year onwards, which is happening. The rate cuts and money printing would not be able to offset job losses and subsequently create forced sales activity. So the RBA's reduced this quantitative easing printing of cash. They've dropped the cash rate, but he's saying that we're now facing economically a tsunami that dwarfs even the worst global trade war. So it's important to understand that the environment isn't good right now. We've still got 10% unemployment. We've still got a lot of people without work or underemployed. We've got a lot of businesses that will fail this year. We shouldn't be taking this time lightly, but I still do believe that we will see a light at the end of the tunnel here.
Definitely. Now, do you want to go into a little bit more about the V-shaped recovery?
Yeah, so he goes on to say that the last time Australia experienced a marketplace like this where there was 10% unemployment was the Great Depression. He's saying that there's a few different options here. So one of them's a V-shaped recovery, and I'm just going to read through this if you guys are okay. He said, let's be clear, despite the positive CoreLogic numbers, dwelling prices still rose by 2.8% between January and March this year in Australia. And that's the same with the last month. Like they've been way more positive in Sydney and Melbourne than we're expecting. We may not have official numbers where the weight of the current environment is showing up in the numbers, and we may not have that for another month or two.
Yeah.
We can see that some of the leading indicators, like the number of comparative market analysis people are putting together, the number of auctions,
clearance rates,
the average time on market, the average vendor discounts. Like these are all very early indicators that we look at that are all looking better as a buyer's market rather than a seller's market.
But that's basically the earliest indication that you can have what way the property market is going to go. So lower auction clearance rates, all of those types of things generally lead to more of a buyer's market, which is what we're finding at the moment, where the start of this year we were having to negotiate over a 1 to 2 day period with real estate agents for purchasing properties. to now we're able to play a lot more hardball with these agents, and we've got much more of the negotiating and buying power throughout the process.
Which is why if you can strategically time these markets as a buyer, you can do so much better, because we want to buy when we have the power. We don't want to buy when we're having to pay 20 grand more than we had to the month before. The best case scenario from here for property owners and investors is one where we get to 0 new cases before the end of April. I noticed, I think it was yesterday or the day before, we had 0 new cases, which is a huge deal. Like, I'm so proud of the way that we're managing this as Australians and socially isolating and making sure we're protecting ourselves. And on that front, the numbers have been looking promising. I believe it is now a 50% chance that our 3 major states will record a 0 new coronavirus cases daily before the month is over. I fucking love this guy.
Yeah.
Like, he's so on stuff before it occurs. If we get to that point, the next question begs, how long will restrictions be kept? Potentially some restrictions could be lifted, which we've seen this week.
In Queensland and New South Wales.
Yeah, I think Victoria is still playing hardball. I wish Victoria and New South Wales would just play real hardball, because with 5 million people in each of the cities, you know, that's a major, major issue. My bet is that when restrictions are eventually lifted, they will be lifted in the reverse order that they were placed, which is exactly what's happening now. As the ban on auctions occurred as one of the last stages, it's quite feasible that lifting the ban could come sooner than expected. If we're able to get back to close to normal business by the end of May, I certainly don't think all restrictions will be added by that time, he went on to say. Then I think confidence in the housing market is going to return, assisted with the stimulus announced and the economic damage relatively limited. It would mean a fall in house prices recorded for the June quarter, but a bounce back in September and December quarters. The net result for the year may come to the scenario 4 range, or even slightly better. It should not be underestimated how much expenditure has been announced, including printing money from the RBA, and how low lending rates are now. A borrower with a good credit rating like myself, Simon, and a lot of you guys listening could now expect a variable owner-occupied rate somewhere between 2.5 and 2.8%. That is absolutely insane. It means that properties, even in Sydney and Melbourne, are so much closer to cash flow neutral.
I was talking to a client the other day who's going through the process of refinancing, and he said that his broker was looking at a fixed interest rate for 3 years at under 3%, like 2.8.
Incredible. That said, though, we think there is trouble ahead for the rental market, and he says we'll talk about that in a moment. Then he says the worst case scenario. The worst case scenario is we have a second wave of new cases, and this is my fear too.
Yes.
I was watching the project last night. I would like to see us keep this current thing going for another month, get to 0 cases for 2 weeks in Australia, and then basically not allow people to come over from overseas for 6 months until we really get a handle on this globally. I feel like letting people back into the community at the moment is too early personally. And, you know, all of the other major countries that have gone on to do this, like England, for example, and America have seen a second flare-up, which is my concern, because it increases the long-term economic impact of not getting back to business as usual. As my wife said last night, she's like, people need jobs and they need income, and this is why they're trying to do this. So I fully get it, but I would prefer to see a hard line for a month with 0 cases and then getting back to full economic recovery, rather than slowly working this out over the next 6 months.
Yeah, it's a tough situation to be in. Like, we've still got our jobs, we've still got a good business and working through this time. But for those people that don't, obviously they want to get back to business as usual as quick as possible. And, they'll lift things and just hopefully that the testing numbers go up. I think that's the only way that we can manage a second wave, is if the testing numbers go up quite significantly once we do open up these restrictions.
Yeah, and then a really hard line on people that have been exposed to people with habit. You know, I was thinking the other day, and I said this to Simon, 100% of people globally feel like they're economically affected by this market, because that's what the media's made us think. But the reality is only 25% of Australians are severely affected right now in terms of like potential declines in their income, increases in their expenses without income, or like, going to part-time, or like not enough hours. So, 3 out of every 4 of us listening to this are in an incredibly strong position and can absolutely smash it. I'm actually saving a shitload more than I was.
Yeah, same.
By not eating out, by cutting some of the non-essential costs in my life, by peeling back parts of my business, by freezing a couple of my home loans for the next 6 months. There's a whole lot of stuff that you can do right now to actually massively improve your position. And Commonwealth Bank has the numbers for that. I'll talk about that in a moment. If this second wave of people affected by the virus occur, we think the housing market will have a much deeper correction. A second new wave of cases is a great risk. A second wave of the Spanish flu hit Australia in mid-1919 and occurred just after the restrictions were lifted from the first wave. We never actually got to zero on the lull. Such a negative scenario would mean current restrictions would stay with us for longer, probably more than 6 months, or worse, more restrictions added. Damage to the economy would be deeper and last longer. Many businesses, including those that are currently on life support, would not last the distance and would be liquidated. Obviously creating massive levels of unemployment. And this is my concern. This is why I want to take a harder line on this personally.
Yeah, well, we've put all of like the freezing your home loans from the banks, the job seeker, the job keeper payments, these are all just being put in for 6 months, which ends sort of mid to late September for most. And understanding that that's how long we've got a good amount of financial support for, I agree. It should be harder restrictions in the short term to make sure that we knock this on the head properly, rather than letting people, get out and about a little bit sooner.
Yeah. He says, even with the generous measures announced for small businesses, based on this worst case scenario, it won't be enough to keep much of the sector alive for half a year. The $1,500 a fortnight in wage relief, as well as the $10,000 cash grants, is not enough to keep most businesses going, especially those like the gyms, the restaurants and the hospitality businesses that have gone to zero income right now. With surging and sustained unemployment rate, the banks could start to get nervous on their mortgages. Potentially after a 6-month hiatus, banks may be backed into a corner where they're forced to repossess or on defaulted housing loans, which, that is not a good scenario. That's the type of thing that happens in a GFC, and that's when you get a flood of distressed properties coming to the market.
It's very interesting that it's all kind of up to us. All of this is really up to us. Like if we do end up lifting the restrictions and getting back into public and getting back to life as we knew it, if we look after ourselves and we make sure that we do the right things, it should be fine. But the only threat is this second wave that could potentially come, which was going to be brought on by us, by everyone.
Yeah. He said, I'm not convinced we'll see a lot of forced sales activity, even if the banks come to that, because in 2008 the Australian banks didn't. Even people that were behind on their loans, they didn't foreclose on them. All the same, there will be many more property owners who will want to sell out if the crisis goes on for more than 6 months or more, which could result in a fall in dwelling prices as people become more and more protective of what's left of their net wealth. The buy side of the equation would be hit hard, as we're seeing right now, but far worse than it was in 2018 or 2008. You see, it's not just a loss of employees representing many first-home buyers, but as mentioned above, potential to wipe out many thousands of small business owners who employ almost 50% of the workforce. Again, let's remind ourselves that the international border is closed outside of residents and citizens, and it could remain closed for a long time. So underlying demand for housing, which has been predominantly driven by net overseas migration, has now stalled. The same thing happened in 1919. In this bleaker scenario, a 30% decline in Australian house prices could be on the cards. Note, I have not modelled this out other than taking elements such as previous work on the relationship between unemployment and the housing market. This is just, his opinion now. It is not data backed in any way, but, that's why all of us have a different opinion, right?
Exactly.
I could easily see this year how prices in Sydney and Melbourne could come back by 10 to 20% in this bleaker scenario, because you've got to remember that in the last 6 months, prices in those cities lifted by between 10 and 15%. So if that hadn't have occurred, you know, the declines might not be so hard. With Sydney and Melbourne representing 70% of Australia's housing market, we could see really negative looking numbers for Australia, but in reality, it was primarily driven by the two markets of Sydney and Melbourne. He said, either way, the rental market's in trouble. Overarching this is the Airbnb accommodation, the lack of immigration, the lack of students, and the lack of tourists coming into Australia at the moment. He thinks in many parts of Australia we'll see vacancy rates increase from 2%, which is very, very low Australia-wide right now, to in some cases up to 3%, which means an oversupply. Some markets like Darwin, for example, are already well oversupplied by that number, and that's why their property prices, or one of the reasons why declines are still occurring. I looked at some data myself recently for the last 35 years, and I looked at the major capital cities, and what I found is that when the capital cities had very strong price growth, it was always in a time when vacancy rates for the capital city was below 1%. There was such a strong correlation there between that and the times where capital cities went absolutely through the roof.
Okay.
So the fact that vacancy rates are getting higher means that short-term capital gains are obviously not going to be on the table, and potentially some declines will come through.
Yeah.
So sorry to geek out so much, but I think it's important for you to have different ideas in this time. I don't know if nothing's going to happen or we're going to see a 30% decline. All I know is that I have a plan to buy in this market personally because it is such a good time to get stuff at a discount. Whether you can stomach that for yourself or you're in a financially stable and safe position to be able to take advantage of it is completely, you know, where you're at.
Case by case dependent it's going to be this year. So yeah, just invest smartly this year.
I've knocked back a lot of people recently who wanted to pay our business, that wanted to come on as clients who I didn't think they were in a strong enough position to buy. You know, the people that can, we've talked about in previous videos on our YouTube channel. So let's hook out of SQM and hook into CBA now.
Yeah, CBA seemed great. I think we looked at a thing just as we were doing this information here, and from 2008, was it, until now, they've been 85% correct with their predictions.
Yeah, so what they do is they model 6 months into the future, and then they overlay the core logic data. And from, as you said, 2008 or 9 till now, that they've had an 85% correlation. So CBA right now is suggesting that Australian property prices as a whole will drop by 10% in the next 6 months based on their modelling. You know, I can easily see how Sydney and Melbourne will wash 10 to 15% off the top right now.
Of course, it's just coming back to where it was 9 months ago, as we said. One of the interesting points that they've said, and you can see it in the numbers there with Australia using about 10% of GDP, but what CBA have indicated is that the government benefit, so the government stimulus, has been higher than the fall in wages and salaries at the moment, which is, I guess, a weird thing to kind of think about.
You think about all of the people out there that are most exposed, like in tourism, in hospitality, in retail. Most of those people aren't making $750 a week after tax.
Yep.
So now that their employers are able to give them that $750 a week, you know, for a lot of people, it's actually resulted in more savings in their CBA bank accounts, as well as much higher incomes than average. Unfortunately, that money's not coming back into the economy yet, but the rule of history is that people that didn't have a savings habit, they get more money, like people that win the lotto spend it. And a lot of these people that are saving it now will end up spending it in the future in the economy, whether that's increasing the place they rent or spending it, you know, just in terms of directly to businesses and blowing that cash.
Exactly. And the other thing they said is there's lower spending in the economy. Now, that's obvious. People aren't able to go out on holidays. People can't go out to the coffee shop for dinner, go out to the bar, all of these things. So it's obvious that the spending in the economy is going to be lower for this point in time. But if people are on average earning more, then maybe they're pocketing this extra cash.
For sure, which is awesome. Like, it's really, really helpful. They go on to say that monetary policy is so favourable right now. We've got a cash rate of 0.25%. As Simon said before, interest rates between 3.5 down to 2.5% are available for owner-occupiers and investors. You've got the government printing a shitload of money everywhere you look, whether it's businesses, big businesses or individuals. There's helicopter money dropping out of the sky to save people. I think the government has done a tremendous job in where they're distributing this money to actually help the people that needed it. By people in really severe financial stress, they can obviously pause their home loans or their investment loans at the moment. People that are, in real distress rental-wise can obviously negotiate something with their owners as long as they can prove it, to say that they can freeze their rents for a while as well. That's not really what I want to hear as an owner. I don't want to be the person fucking bailing someone out who can't afford to pay me rent, but I understand that this is bigger than me.
Yeah.
And this is saving everyone and looking after the good of society. And, my values are very much aligned to that.
Exactly.
The good for all, even if it's a period where I have to pause my home loan because, like the other day, someone just stopped paying me rent, left the keys in the sink and sent my manager a text message saying I'm out. Luckily, it was 3 days before the new law got passed in and I was able to look after myself properly. If the same thing happened now, I don't think I'd be able to have a legal foot to stand on like I did at that time.
Yeah, exactly. And another thing that we read from a different company, I think it was Cycles Trends Forecast. I'm not 100% sure who wrote it, but they were talking about the fact that all of these rules and regulations that were put in place around 2018 because of the illegal work that was happening in the banking sector has pretty much been put on pause right now. And she actually indicates that they probably won't come back either. So that's going to make money a lot easier for people to get, and in turn, hopefully stimulates the economy a little bit faster.
For sure. They made it pretty hard between 2016 and the end of 2019 to borrow money. And a lot of you would have felt that. It's becoming so much easier to grab money right now. Although one thing you need to be aware of is the banks are devaluing valuations on properties right now. So if you are grabbing equity, it would be worth this much to sell on the market, but your bank valuation might come back a bit conservative. And just generally times during this, like this, with this sort of risk, this is just a normal thing that they do.
Exactly. They're just managing their risk and being conservative right now, like everyone is.
So let's talk CoreLogic for a moment. Obviously, CoreLogic's the big boy in the industry. They've got all the data that everyone else is making decisions from, including CBA, SQM, Phil Anderson, myself, the Reserve Bank even, plugs their data in. It's that high quality.
They've got pretty much the best real-time information at any given time. So they've talked, I think I'm getting 2 emails a week from CoreLogic at the moment with different coronavirus-related articles, and it's been the same trend a few months ago. Probably 6 weeks ago, it's I don't know, to now starting to see some actual data that represents something that we can kind of use to forecast the future a little bit better. But this has obviously had a massive, dramatic impact on the listings.
As the demand has come down, the listings numbers have come down. So it would be really, really bad if the demand had come down but the listings had gone up.
Yeah.
But we've seen both come down together, which is one of the reasons why they don't think there's going to be as big a bleed as maybe first expected with property. One
of the other things that they were talking about is how resilient the property market has actually been. The numbers for March came out quite positive Australia-wide. They saw slight increases, very small increases in Sydney, Melbourne and Canberra throughout March. Places like Brisbane, Adelaide and Perth were down, but very mildly as well over that March month as well, which was great to see. They even did data up until the 21st of April to more accurately reflect the month where the virus has been in place. And same scenario, shocking. So that's what they've gone on to say. It's been extremely hard for them to digest, and SQM Research has sort of said the same thing. Everybody's expected this catastrophic property environment, but the values haven't gone down. Yeah.
If you're thinking about it from a purely what should happen perspective, if the government hadn't have stepped in, I think we would be seeing things in a much worse condition. But the government stimulus has been so strong and so specific to the vulnerable parts of the economy, like the low-income earners, the renters, and the people in financial distress that can just literally freeze their payments for, like on their interest and principal for the next 6 months, that it's probably had an effect where some people that should be selling properties now don't have to.
Yeah.
Which is really powerful.
And you can see how the correlation between the worst case scenario from SQM and that information, if things have been put on hold and if we do get this second wave and it pushes out further than that 6 months, then all of these things coupled together, there's going to be some tough decisions to be made from the banks, from landlords, from the government in order to keep going, which is why I hope with all of my being that there isn't a second wave. And I hope that when we do get back into society that people can really look after themselves and follow the rules to make sure that they don't get this second wave.
For sure. Another interesting thing is that they expected the number of distressed sales to massively spike, but there's absolutely no evidence at the moment that the number of that there's more distressed properties coming onto market. In fact, I think it's the lowest that it's been in a very, very long time right now, which is super interesting. But you think about it, like if I don't want to move right now, if I don't have confidence to think that it's a good time to sell because I might sell for 5 or 10% below what I could have a month ago, if I'm financially secure in my home, and on top of that, if I can just freeze my loan for the next 6 months, I'm going to get through this particular period of time. So super, super, super interesting. Now let's really quickly finish off the video by talking about what the Reserve Bank of Australia has been saying as well.
So they're expecting the GDP to be down around 10% by the end of the June quarter. They're expecting unemployment to be down or to be at 10% by the end of the June quarter. It could potentially even get a little bit lower than that. They're expecting extremely low, if none, inflation throughout 2020 and about 6% unemployment over the next few years. But thankfully, the government has been pumping lots of cash into this, and we were in an amazing situation before coming into the coronavirus, and it's hopefully going to help us come out of this.
The beautiful thing about Australia is we are quite conservative. We do stack some cash away. We've had this incredible commodities boom over the last 10 years, which has resulted in, a much better position to go through this environment in for our government than a lot of the governments around the world. And Australia is certainly much better placed to handle this. We've still got much more money that we could access if we needed to further stimulate the economy from July to December this year. I hope you've enjoyed this update. I know it's been super, dull in a way. It's not our favorite content to talk about the data in this way. I certainly like being a bit more conscious, a bit more positive, and a bit more educational, but it is really important every now and then to take stock on what's really going on, what different people are saying and the differences in their opinions. Summarizing it all, the world economically is not in a great position right now, and Australia isn't either. Luckily, Australia has come into this in a strong government position. The government's taken extreme action very quickly, and thankfully our medical system is dealing with this virus very well, and people like you and I are following the rules, self-isolating and doing what we need to do until we get out of it. There's going to be a lot of people that are burnt and hurt through this. There's also going to be a lot of people that use this to pick up stocks at ridiculous prices, properties at ridiculous prices, and really set themselves and their families up for the future too. It does look like, based on all of the numbers, depending on, doesn't matter who you're listening to, that it's going to get worse financially before it gets better. And the longer that it goes on for, the worse the financial environment is going to become. So that's something that I'll be looking forward to a lot in the next couple of months, to see how the virus is tracking and how quickly we can get back to interacting with each other, supporting all of those cafes, restaurants, bars, tourism businesses that are struggling again. Some of my favorite things to do are support those people in the community. And, the next 6 months, when you see that prices have declined in Australia by 5 to 15%, which is likely. Just know that that is driven 100% by Sydney and Melbourne, and that other markets like Brisbane, that's cheaper to buy than it was 12 years ago, Perth, that's cheaper to buy than it was 13 to 14 years ago, according to CoreLogic, might represent a much better scenario for you if you don't want to like over leverage yourself and then, lose a big chunk of cash in the short term.
For sure. So we'll continue to do these updates as often as necessary with all the information that we get from all of these different sources. If you are thinking of somebody that will get a lot of value out of something like this, please share it with them. Leave some comments below if there's some information that you've heard about in the market that we haven't talked about today. And yeah, just invest with a little bit of caution this year.
For sure. We appreciate it, guys. Really looking forward to the next episode, which should be a hell of a lot more upbeat. Don't mean to be morbid, but it is important to protect yourself, to know what's coming, and then to make a really smart decision for yourself. Now, I personally am still going to definitely buy 2 properties this year.
I'll be buying 1.
Yesterday, I finally got to my savings goal after busting my ass for the last year to save some money. Finally got my wife not spending that money. This is purely for investing. I'll be doing a couple of videos and podcasts with my wife for the first time later today as well. So that'd be funny hearing her giving me shit about what it's like to live with me and what our journeys look like from her perspective, not just mine, who's always like, trust me, babe, the future's going to be good if we just do this. And she's been the one sacrificing so many things all the way through. But yeah, I'm looking forward to doing that. Really appreciate your time. Please stay safe. SQM, CoreLogic, Phil Anderson, Fred Harrison, CBA, they're your go-to through this period. Ray Dalio, learn from the best and make smarter decisions as we do this. Cheers, guys.